Imagine waking up to see a company Wall Street once celebrated as the next revolutionary food giant, a stock investors pushed beyond $200 per share, now circling $1 as if suspended between survival and disappearance. A company that once promised a global food transformation now signaling distress through a debt exchange so unusually large that it could multiply its share count several times over. A company that spent years telling investors its long-lived assets were fully valued, only to suddenly declare those same assets needed material impairment. And a company whose stock, in one of the strangest market episodes in recent memory, exploded more than 1,000% in a matter of days before falling right back. For seasoned investors, these events are not just concerning. They are deeply abnormal in a structural way, the kind of abnormalities that usually indicate unspoken stress points or inconsistencies in disclosure that have not yet been fully explained. To understand how this mystery formed, we need to return to the beginning. Beyond Meat, a US-based NASDAQ company, entered the public markets during a cultural moment. Normally, when consumer goods brands go public, they grow in a predictable sequence, with distribution expansion, gradual margin improvement, and brand consolidation. Beyond Meat bypassed this order entirely. Its ascent was driven less by fundamentals and more by narrative momentum. The global excitement around plant-based protein, the environmental storyline, and partnerships with major restaurant chains pushed the stock far beyond what traditional metrics could justify. But financial gravity always returns. Between 2022 and 2023, U.S. retail volumes did not decline slowly, which is the usual pattern in consumer category fatigue. They dropped abruptly. Total company volume fell from around 80 million pounds to roughly 70 million. A drop this steep, especially while distribution was still expanding, is unusual and hints at deeper structural issues like weaker repeat purchase rates, a widening taste gap against traditional meat, and inflation-driven price sensitivity. While this contraction was unfolding, the company began a global operational review. Usually, such reviews update the valuation of long-lived assets, like manufacturing equipment or production facilities, and impairments are recorded when future cash flow expectations decline. Beyond Meat instead reclassified certain assets as held for sale, but recorded no impairment. That was the first major anomaly. When a company faces declining demand and weaker margins, impairments are normal. The absence of impairments under such conditions suggests assumptions that were unusually optimistic or valuation models that did not reflect